Good afternoon. My name is Bill Sinnott, and I am Chief Operating Officer for Financial Executives Research Foundation, which is FEI's research foundation, also known as FERF. We want to thank you for joining us today for our anti-fraud collaboration webcast titled Data Analytics to Deter and Detect Fraud. As you may know, the anti-fraud collaboration is comprised of the Center for Audit Quality, the Institute of Internal Auditors, the National Association of Corporate Directors, and Financial Executives International, or FEI. I will be the moderator for today's webcast. Before we start today's webcast, I want to review some housekeeping notes. Today's webcast is worth 2 CPE, or Continuing Professional Education credits, and to be eligible for these 2 CPE credits, you must first answer at least 4 of the 6 polling questions during the webcast and have a total viewing time of at least 105 minutes. Participants will have the opportunity to download their CPE certificate immediately following the webcast if these requirements are met. In accordance with standards for the National Registry of CPE Sponsors, CPE credit will be granted based on a 50-minute hour. We are unable to grant CPE credit in cases where technical difficulties preclude eligibility. CPE program sponsor guidelines prohibit us from issuing credit to those not verified by technology to have satisfied those minimum requirements listed above. If you do have any questions for our panelists, please type them in the text box on your screen, and we will address as many as possible at the end of the webcast if time permits. So as I said, I am the moderator for today's webcast, and here is my bio. I have been with FEI and FERF for over 30 years, and we have always been looking for better ways to deter and detect fraud. One of my first research projects with FERF was actually the staff support for the original COSO Integrated Framework project when it was done for COSO by Coopers & Lybrand. Now, before we introduce our panelists, we want to take a minute to get to know you better. So this is our first polling question. Please tell us what would best describe your role. Your choices are internal audit, external auditor, financial and accounting, or D, academic/student. And we'll take a few seconds to give you an opportunity to pick one of those and let us know about you. We're just waiting for these results to be tabulated, and we'll get started in just a moment. We want to thank you for your responses, and now I would like to introduce our panelists. Jeremy Clopton. As a director in BKD's Forensic and Valuation Services Division, Jeremy specializes in data analytics with applications in fraud prevention and detection, risk assessment, and business intelligence. Jeremy's project experience includes the development and implementation of analytics programs for Fortune 500 companies, development of analytics for compliance with anti-bribery and corruption regulations, and investigative experience working with criminal justice organizations. Carolyn Newman. Carolyn brings more than 30 years of experience in public accounting, auditing, and consulting to her role as president of Automation Services, Inc., which is the U.S. business partner of Caseware Analytics. In 1992, Carolyn co-founded Automation to help financial professionals use technology to benefit themselves and their organizations. Prior to that, Carolyn served as Regional Technical Director of Computer Auditing with BDO Seidman. Next is Bill Pollard. Bill is the Midwest leader of Deloitte's Foreign Corrupt Practices Act Investigative and Consulting Services Group. He has spent over 2 decades providing forensic accounting services to clients in the manufacturing, retail, financial services, professional services, real estate, construction, gaming, healthcare, and not-for-profit industries, among others. These engagements have involved complex accounting and financial issues. Bill's experiences include FCPA investigations, acquisition due diligence inquiries, and compliance reviews in Europe, Africa, the Middle East, Latin America, and Asia. Finally, Patrick Taylor. Patrick is CEO of Oversight Systems and is an authority in the convergence of business analytics, information security, and the implementation of technology to boost organizational performance. Patrick recognized that most IT security and financial system controls focused on user access and role management, but did not address how to convert ERP, CRM, and other financial transaction resources into plain language, actionable insights. After speaking with executives from across the country, Patrick launched Oversight Systems to pioneer the concepts and technology for continuous transaction analysis. Today, we will discuss data analytics and how they can help you detect and deter fraud within your organization. Here is today's agenda. You can see that we plan to discuss data analytics, fraud detection, and continuous monitoring. Towards the end of our webcast, we will provide a call to action and some best practices that you can implement today at your company. Okay, now let's review the results of our first polling question. Results from our first polling question revealed that most of our participants are internal audit, with about 62% of those on the line working in internal audit. Next is financial accounting, then external auditor, and just about less than 2% of our participants today are academics or students. So at this point, let's ask our second polling question. What type of organization do you work for? Here your choices are public, private, not-for-profit, or other. Give you just a minute to fill that, reply to that question. Okay, Bill Pollard of Deloitte is our first presenter today. So Bill, how are data analytics being used today in fraud investigations, and how important are fraud risk assessments? Finally, how can data analytics help your company?
Well, good afternoon, Bill, and thanks for those questions. And over the next few minutes, I'm going to spend quite a bit of time talking about all 3 of those topics. And the first one being data analytics being used in fraud investigations. I've been doing fraud investigations for over 20 years, and the evolution of the use of data analytics is absolutely increased over time. And as you'll see throughout the discussion today, I think it's an imperative that data analytics be part of investigations. And as it relates to that, the idea of fraud risk assessments also supporting analytics, we'll spend some time talking about that topic as well. So why don't we start with the evolution of data analytics, and this is really more around the evolution of excuse me, of considering fraud through the use of data analytics over the course of time. And if I can take the audience back to somewhere in the late 1980s or early 1990s, when you think about fraud and fraud risk management and how companies address the risk of fraud. It's a little bit like that picture that you see on the left there. There was, for example, in place an auditing standard, SAS 82, which addressed an auditor's obligation from an external perspective to address the risk of fraud. But beyond that, I'd say there was mostly a passive approach that companies took to fraud. If you tripped over it, if it was staring you right in the face, and you were forced to have to do something about it, you did. But beyond that, there was not a proactive approach to looking for fraud. There were no fraud fighting units for the most part in companies. There were no fraud policies in place. There were not really even any investigation teams focused on financial crime. Granted, that's probably a bit of an overstatement, and companies who operate have always operated in very highly regulated industries that required some level of scrutiny for the risk of fraud may have had some things in place, but not what we're seeing today. And then along came the Sarbanes-Oxley Act of 2002, enacted in July of that year, resulting from a number of the financial scandals that were taking place in the early 2000s, the Enrons and WorldComs of the world. And all of a sudden, you started having a much greater attention being paid to financial statements, and the users of financial statements demanding more comfort that the information that they were reading was free of fraud risk, or to the extent that it could be materially eliminated. And so, along with the passage of Sarbanes, and over time, a couple of economic downturns, including the financial crisis in '08, the expectations placed upon companies to manage and mitigate the risk of fraud, as well as the government's more focused oversight on this risk, has put companies in a position that they needed to answer the question, what should I be doing to address this risk? And so nowadays you start to see many more companies, if not most companies, having some sort of fraud fighting function within their organization, whether it sits in legal or compliance or internal audit, but that there is a group of individuals maybe that are responsible for addressing the risk of fraud. There are investigation teams that exist in companies that are focused on addressing the risk of fraud and investigating financial fraud and financial crimes. Fraud audits are being conducted by companies, and what I'll be talking about in a minute or two, including things like fraud risk assessments. As well as, I think, companies independent of what the government may expect of them are realizing that the challenges of being, in many instances, more global in nature or interacting on a global platform, the disparate accounting systems that that companies may be forced to use or choose to use based on how they've grown through acquisition and bolting on new accounting systems has created challenges and increased the potential risk of fraud. And just the complex nature of transactions that take place these days has also focused on helping companies realize that they need to do more from a fraud fighting function. And candidly, the government hasn't gone away. Issues such as the Foreign Corrupt Practices Act that deal with bribery and corruption associated with non-U.S. government officials are causing companies who deal internationally and potentially interact with governments and government officials to focus on how to address that risk. And so, as we move on here, and I start thinking about how companies are actually managing all of these different challenges that they have, one of the ways that they continue to enhance their efforts and seeing more and more companies adopting this is the concept of a fraud risk assessment. The thought is that how do you know where to go from a fraud risk mitigation perspective without knowing where you're at right now? And a fraud risk assessment allows companies the opportunity to be able to understand what risks they really have within their organization and the best way to go about mitigating those risks. So when you think about the process, it's a very straightforward process. And as you can see on the screen there, you'll see things like identifying fraud risk factors and identifying fraud risks and schemes. One of the keys to a robust fraud risk assessment, an assessment that will help you direct where your resources should be deployed, including those we're going to be talking about today, data analytics, is understanding what are those factors, what are the incentives and pressures that would drive an individual to perpetrate fraud, whether it's fraud internal to the organization or fraud from third parties being perpetrated on the organization. And so coming up with the ideas around those factors and then thinking about, well, if I know areas of vulnerability in my organization, places where there are incentives or pressures to commit fraud, how would it go about being committed? What types of accounts would have to be involved? What types of individuals within the organization might be involved, or external to the organization might be involved in actually perpetrating those frauds, and what kind of schemes would they have to undertake in order to be able to have a fraud materialize? And then from there, stepping back and saying, and I think for many of the auditors that are on the call here, will understand impact and likelihood, to understand where the frauds may materialize. What is the possibility that a fraud we can think of from our scheme perspective would actually turn into a fraud, and what kind of a impact would that have on our organization? Using that concept to rank or evaluate the overall fraud schemes that you come up with, and then look at the controls that you have in place to address those fraud risks that you have identified as being more significant or higher risk to the organization. Assessing the controls that you have in place and looking for gaps. Where are the areas where I might not have controls in place to address those risks? And then what would I need to do to fill in those gaps? What types of controls might I consider putting in place to mitigate that risk? And so many companies are now starting to undertake that exercise and actually using it for the purpose of guiding their data analytics and how they deploy analytics for mitigating the risk of fraud. So as I think about things like using analytics to identify potential fraud risks, so transaction testing or running scripts across data, which will be talked about in detail coming up, but using data to help me understand what are the risks that I'm trying to mitigate. It's a much more proactive approach rather than waiting for a fraud to exist, to develop, and then investigate it afterwards. It's much more efficient and effective to take a much more proactive approach. Candidly, the government expects it now of companies, both public and private companies, to monitor the risk of fraud in your organization, to take a much more proactive approach, and then to make sure that you're sharing that information with those internal to the organization that need to be aware of it. And when I think about how the fraud risk assessment done in the right way, utilizing analytics to help support it, it becomes a very useful tool for a wide audience that may want to use a fraud risk assessment. So, for example, your internal as well as external auditors. For internal auditors, fraud risk assessments are very helpful in helping you decide where you're going to audit, what you're going to audit, how deep you may need to audit. You have limited resources to be able to conduct audits, and so the ability to laser focus in on those places that you should be looking at in particular to address the risk of fraud. Data analytics is a key component to helping you get there. The compliance departments are using analytics more and more to assess the risk of fraud in various areas of compliance. Outside agencies, as you may hear and have heard recently, the SEC, the DOJ have brought on new individuals into their organization and new tools and technologies to help them mitigate or focus on highlighting areas of fraud risk that they want to go after with companies that they have an interest in, and so they're doing their own types of fraud risk assessment through analytics. And more broader audit committees, boards, and businesses just at large are taking a much more proactive approach to using information gleaned from fraud risk assessments to enhance governance, enhance policies and procedures, enhance the operations of the business, because the more you know about the risks to the business, the more you're able to do to help mitigate those risks. And so, as I think about the role of data analytics and what it plays in today's company as far as a fraud fighting activity, I just can't imagine not using technology these days to help fight the risk of fraud. There's just so much data out there, and companies need to find ways to get a better handle on how to use their data in ways that they can proactively address the risks that they're trying to address. And when you think about the who, what, where, when, whys, and hows of fraud, I have many examples of where we have helped companies with issues where a fraud has occurred. They've heard about it through a whistleblower. They have gotten their hands on the data associated with that risk or the allegations that have been made, and the ability to cut out hundreds and hundreds of man-hours of digging through paper and digging through accounting records, trying to find these needles in the haystack that sometimes come through a whistleblower hotline, and using analytics to help you separate, so to speak, the wheat from the chaff, to focus on the accounting transactions that have a much higher likelihood of being anomalous, of being a transaction of interest. And so the idea that you can do this without technology, especially in 2015, I think is going away more and more, and companies are realizing that in order to be able to truly be sufficient in this space, you need to focus on somehow or other deploying technology in order to be successful in your fraud fighting efforts within your organization. So maybe at this time I could turn this over to Jeremy. And Jeremy, as I've started just touching very, very briefly on the topic of data analytics, maybe you can give us some background on data analytics and start us off.
Yeah, Bill, I really appreciate it. I think you've really drove home the point that analytics really needs to become part of what we're doing, not just something else that we do. From the fraud risk assessment through everything, it's really becoming part of the process. And I think one of the best ways to learn a little bit of foundational material on analytics is to talk about it in a way that everybody's probably already using analytics. And I'm going to borrow a story from Target, and this is not the data breach that everybody's probably already familiar with and heard quite a bit about. But this is actually going back a few years ago where a man entered a Target store demanding to speak with a manager, had coupons in his hand, demanded to see the manager, and wanted to know why on earth his high school daughter, who was a teenager living under his roof, was getting coupons for baby-related items, whether it was maternity clothes, whether it was baby cribs and strollers, but why on earth she would be getting coupons specifically for that. Asking the manager essentially was Target trying to encourage her as a high schooler to get pregnant. And the manager was taken aback. He didn't know what to do. He looked at the coupons, and in fact they were addressed specifically to her, and he apologized profusely. Well, as the story went, he called the man back about a week later to apologize again, at which point the man actually stopped the manager from Target and said, sorry, I actually need to apologize to you. It turns out there have been some things going on in my house that I'm unaware of. In fact, my daughter's due later this summer, so I owe you an apology. And it's amazing that that's essentially what was used was analytics. Target was using purchasing data. You have a loyalty card, you have an online shopping profile, you're out there you're creating data about purchasing patterns, and that's essentially what analytics is. It's using that data to get useful information. We've all been inundated with data where we have so much data that we really don't know exactly what we're going to do with it. But we take that data and we determine, okay, how exactly can we use this data? What can we get useful information out of it? And essentially that's what we're doing, is we're trying to answer this strategic question. And in Target's case, their strategic question that they're trying to answer was, how can we better market to our customers? And really, analytics can be used very easily, as we've been already talking about from a fraud risk standpoint. It's how can we better address fraud risk in our organization? Where does it occur? How can we prevent it? And that's how analytics translates across the organization in so many different capacities. That's how internal auditors, external auditors, finance and accounting, marketing, HR, essentially everybody in an organization can be using analytics in a different capacity, because it's a process. It's not any one thing that's only marketing or it's only fraud. It's global. And a couple definitions here that I think really set the stage well for this. The first is big data. Big data is a term that we've all heard. We've heard it a ton. As Bill alluded to, there are a lot of companies, they're bolting on the new accounting systems. They have very complex transactions, and have a lot of different systems, not even accounting, but just a lot of systems that talk together. And if we look at the Gartner, one of the definitions of big data from the Gartner's website, it's information of extreme size, diversity, and complexity. And I would say that even if you don't have terabytes or petabytes of data, a lot of you on this webinar, and my organization included, has big data because you have a lot of data that is very diverse and it's very complex. Now, it may not meet the technical IT term of terabytes. Well, you still have the principle of big data. It's very diverse, it's very complex, and that's one of the things with all the accounting systems out there today and the various systems that start to talk together, we have something that's incredibly complex, which means that we do need to have a big data mindset. Now, even if you don't want to call it big data, maybe you just say you have data. That's really all that matters is you have data. You need analytics, which you can see there again. It's getting the useful information from our data. It's not looking at everything to look at everything. It's looking at everything to get something useful out of it so we can go back and we can answer a strategic question. And with that, we're going to touch a little bit more on some foundations here, but going back to polling question number 2, I'd like to check in on the results of that here and see what types of organizations do we have represented here, because I think a lot of the examples we're going to have today are really going to be globally responsive, but it looks like here the majority of our attendees are from public organizations, about a 25% from private. We have about 17, just shy of 20% there, not-for-profits, and then others. And we can see that that's a very diverse audience. Public companies, you all know and have seen analytics from the government standpoint, as Bill alluded to, the requirements there, private to a degree as well. But no matter what organization you're in, it's going to be applicable. And with that, I want to move on to polling question number 3, following on what Bill had talked about there. And polling question number 3, we're going to give you some time to answer it here, but does your organization perform a fraud risk assessment? And we have 3 answers here for you to choose from: yes, no, and not sure. And again, this doesn't necessarily mean are you the one performing it, but does your organization in some capacity perform a fraud risk assessment? Again, 3 options for you here: yes, no, and unsure. And from there, we'll go ahead and move back into some of the foundational material here. And when it comes to data analytics and using the data, it's interesting from the finance and accounting standpoint. We're very familiar with data. We all have data. We see data day in and day out. But what we don't really see is all of the data in our organization. Historically, we focused on the structured data, and you can see here on the screen that structured data is now a small component of the data that our organizations have. We used to have mainly structured data, and structured data is essentially the data it's easy to deal with. It's in a column and row format. It has headers. It's pretty to look at. It fits in Excel nicely. We like structured data. But really, that's only about 20% or maybe even less than 20% of our organization's data today. We have a lot of unstructured data, and that's all of the other data that's out there in emails, social media, web forms on the internet, PDF files, Word files. There's a whole host of information out there and data out there that we have in our organizations that we're really not tapping into because it's unstructured. And as it comes to truly using our data within our organizations to do a proper fraud risk assessment and really incorporating data into that, we need to be looking at all types of data, not just the transactions from the accounting system. And there are a number of tools out there that we can use as it relates to data analytics and leveraging the structured data and the unstructured data from within our organizations. We have quite a few different tools here, and you can see on the screen we've got a few of them listed, the more analytics number crunching on the left, and then more the visualization types on the right. And really those tools are all commonly available, easy to access. But what I would challenge you to think about is what tool does everybody on this call have, where if you're not using analytics at all, you can get started with, and that's Microsoft Excel. Now, I'm not going to say that it's one of the most robust tools out there, but it is a tool that can help you get started with analytics. And if you do nothing else as a result of this webinar, I hope that you will at least explore what you can do with what you already have so you can start to make a dent in the fraud risk in your organization. Now, before we get into talking about the various types of analytics and the various types of fraud that we can be addressing, we're going to look at the results of polling question number 3, and it does look like the vast majority, nearly 60% of the organizations on the call, on the webinar here, are performing a fraud risk assessment. And Carolyn, I'd be anxious to get your thoughts, seeing about 60% that are performing a fraud risk assessment.
Oh, thanks, Jeremy. I did expect the majority of people to be saying they were doing a fraud risk assessment because it's actually a standard. If you're an internal auditor, I believe a fraud risk assessment is required, and also external auditors need to be doing that in consideration of fraud in financial statement audits. It's like trying to go on a trip without having a map. So one thing I'd like to share with everyone is something a client told me last week. He has done he's a chief auditor, and he's done his fraud risk assessments for a number of years. And this year he decided that he would bring in a co-sourcing firm to do it, because he said, from his fraud risk assessment, he knows what he knows, but he doesn't know what he doesn't know. So bringing in a firm to help him with the fraud risk assessment actually gave him some new insights and some new places to look. So if you're not doing them yet, or if you're doing them and you want them to be better, you might consider something like that.
I think that's a great piece of advice there, Carolyn. I think anytime we can get an outside perspective, even as it relates to analytics and what types of analytics are useful, that outside perspective, whether it's from somebody in a different department or somebody outside the organization, can be very, very beneficial to every organization here. Let's go ahead and move on to polling question number 4. And this is kind of a big loaded question here for the webinar today. So we're curious, does your company currently use data analytics to detect fraud? And that's probably a bit of a loaded question if you're on the webinar here. I'm guessing quite a few of you do. But we'd be interested to see, does your company currently use data analytics to detect fraud? Again, our answer choices here are going to be yes, no, and not sure. And we'll give you just a few more seconds here so you can answer this polling question. Again, your answers being yes, no, or not sure. All right, we'll come back and we will discuss the results of that 4th polling question here in just a bit. But we're going to go back and we're going to focus again on today's strategic question. And what are we really here focusing in on? And that's the different types of data analytics that we can use, and really how can we use analytics to better manage fraud risk in our organizations. As I mentioned, anytime you're using analytics, you need to have a strategic question that you're focusing in on. That way you kind of have that vision as to what is it you're trying to even accomplish. And today that's going to be the strategic question that we're going to try to answer, is where in our organization, how can we use analytics to better manage that fraud risk? So some of the types of data analytics, I'm going to break this down into 3 categories. We're first going to touch on structured data analytics. From there we'll move into visual analytics. And then after that we'll talk about unstructured analytics, unstructured data analytics. So from the structured standpoint, traditionally we see these analytics break down into really 4 different categories: relationship-based analyses, trend analysis, outlier identification, and then patterns recognition, and really going in and determining what are the unusual items here. As it relates to the structured data, typically we're talking about attributes and transactions within our files. This is a lot of times within the accounting system, the ERP system, or maybe even our CRM system. And the first type is a relationship type of analysis. So an example as to how this relates to fraud risk, you have an example on your screen here from a government organization. And what we have is we have 2 employees whose last names are both Davis. And they actually match up to a vendor, Davis Designs, that's in the vendor file. And this was found by simply taking the address information, the tax ID number, the name information from the employee file and matching that up to the vendor file. So what are the relationships between the 2? We can see that both employees actually share the address of the vendor. The last name is part of the vendor name. And George's Social Security number is actually the tax ID number of Davis Designs. Now you'll see on the right that it's only about $6,000 in payments, but again, this was a government organization with an ethics statute that said they can't do business with an employee-owned company. And I think you'd be hard-pressed to prove that point A on that map, if that's the vendor and both employees, if that's not an employee-owned company. It's very important that we take these basic attributes and find these relationships, and then also taking it to the next level. Relationship analysis as it relates to geocoding and the latitude and longitude information of vendors and employees and other relevant locations is very important. In this case here, what had happened is there was an employee that had set up a fake vendor at a UPS store. Physical address, looks like it's completely legitimate, but much like a post office box, that's an anonymous address. And as it turned out, the UPS store actually was right on the employee's route home. Now, yes, they maybe could have taken a faster route home. That's not the point of the slide. But essentially what was happening is this employee was able to funnel money to a fake vendor at a UPS store that they passed by every single day on their way to and from their employer. And what that allowed them to do is essentially funnel fictitious payments over there, pick them up, and as we all know, you can simply deposit the checks on your phone anymore. You don't even have to have a bank nearby. And time and again, we've seen this type of thing happen where people have sent checks either to a post office box near their home, UPS store, mailboxes, etc., any of those mailbox service type vendors. So we want to be looking at relationships not only between the vendors and the employees that are direct matches, but also with a proximity focus, looking at latitude and longitude, high-risk types of vendor addresses such as a mailbox service, a post office box, or maybe even a missing address. And what does that truly mean for us from a relationship standpoint? As it relates to trend analysis, there are two trends that I think are very important here. The first is an acceleration pattern, and if you look at most of the large fraud schemes, especially those that relate to an embezzlement, for instance, City of Dixon, Illinois is one that comes to mind. Saw one out of Washington, D.C., both of them in the multi-million-dollar types of schemes. They typically start off pretty small with somebody that kind of tests the water a little bit. They back off once they get a little bit nervous. They don't know if they're going to get caught or not. And then once they realize nobody's really looking, it ramps up. Another great example of that, if you go to the Journal of Accountants, there was actually an article related to Nathan Mueller and a fraud at ING, and this describes it pretty well to a T. Started small, built up, got scared, backed off, and then over 4 years ended up taking about $8 million. It's a pattern that we see time and again. It's very important to focus in on these key trends. The other one as it relates to purchasing frauds would be valleys. So you have a vendor that's in the system, which is the hardest part of getting a fictitious vendor, is just getting them in the system. And then essentially they're not used anymore. Somebody goes in and changes an address, figures out they can just abuse that vendor, and then they start to cut checks. So we're looking for those patterns of anomalies in activity. Another type of pattern that we might use that's not necessarily trend-based, but it's how data relates to each other. As you can see here, the relationship between the red and the black lines is very important. And what this is a purchasing fraud where the purchasing manager was calling contractors and saying, here's the low bid, I need you to submit lower because you're giving me vacations and kickbacks and there's corruption going on. And the black line essentially represents that individual's termination date, the red line the activity prior to and then afterward. And you can see that no longer are they using these contractors because they needed that information coming from that purchasing manager to say, hey, we need to know what the low bids are so we can get that in under that. And how that data relates and how those patterns relate to key points within purchasing and payroll and bringing the disparate data sets together like Bill alluded to earlier is very important. And finally, simply looking at outlier identifications, I think everybody can look at the dark blue line in the middle of this graph and probably see the 2 or 3 bubbles that are really important, where you have typical activity around $200 to $300, maybe $1,000, and all of a sudden you have a $10,000 item. It's pretty easy to see with an outlier identification, which kind of leads directly in to visual analytics. When it comes to visual analytics, we have 4 things going on here as well that we typically see: community detection, timeline analysis, geographic mapping, and then risk heat mapping, which as it relates to the fraud risk assessment is very important. So a couple quick examples on those. Community detection here. This is an example, not necessarily of a fraud. This is actually my LinkedIn connections. It's a map, and you can see the various colors represent the various communities, how I'm connected to people. Using this visual makes it very easy to determine where connections come from and where relations relate to. Applying this within a corruption framework and how employees relate to vendors can be very helpful. Timeline generation can be very useful as it relates to surveillance and looking at when are employees accessing the system and should they be. So if we have a potential issue related to journal entries and financial statements, maybe we need to be looking at when are employees logging into the system, when are they accessing the accounting system, from what IP address, does it make sense? And actually seeing when these things take place and does that make sense as it relates to the expectations for that employee. Risk heat mapping is one that I really like. In this case, this is a crime risk heat map, and you can see the great thing about a risk heat map is you can very quickly understand what it is. Red is bad, green is good. We don't have to really take too long to interpret it. And as it relates to a fraud risk assessment, anytime we can use analytics to come up with a heat map of risk and red flags, that's going to make that risk assessment all the more easier for somebody to understand, because we're going to have to communicate likely this fraud risk assessment using analytics to somebody else in our organization that may not be quite as data savvy or as much into analytics as we are. So we need to use this type of a form to help explain that even to others. And then finally, geographic mapping is something that's very useful as it relates to vendor locations, where employees are, looking at spending by location. When you're looking at your risks and fraud risk in particular, this can help you to identify, again, patterns and outliers outside of the geographic norm. Do we have one zip code where there's only one employee and there's only one vendor? They're the only ones within 100 miles and we're spending $1 million there. If so, I probably have a question about that vendor that I want to know, and I want to know why exactly that's the only vendor in that city and we only have one employee there. So using geographic mapping can help us there as well. This is going to lead us into, finally, unstructured data analytics. And unstructured is essentially all the other data in our organizations, whether it's email, social media. And unstructured data analytics encompasses a whole host of things, as you can see here on the screen. I'm going to touch on a few of those. The first is digital forensics, which is really the foundation for text analytics and unstructured, and that's the preservation and recovery and analysis of really it's anything from any type of digital media. It's not just computers anymore. It's computers, it's phones, it's Fitbits, it's Google Glass. It's all of the various gadgets and gizmos that we have that capture data about us. And in the Internet of Things and wearable devices, we have more and more of this, and it's very important for us to use that data. And as it relates back to communications data, we have a few things that we can use from communications internally through email, social media, that can then relate back to what we're doing with the structured data and kind of marry the two together, the first being a network analysis. And when you have a network relationship analysis, it's very important to figure out who are the key players in your organization, who are they connecting. You can see here on the screen we have Anthony who has a red dot that really connects two different communities. If that's a key purchasing director, all of a sudden I have questions because that person is really controlling the flow of data and information between two key communities, and they have a lot of influence in that network, and I need to know how that relates to my risk and other vendors, other contractors, other customers or employees that we're doing business with. So network relationship analysis is very important, as well as tone detection in email. One of the great things about the advances in technology is there are now solutions out there that will help to get the emotional tone of an email. The solution that we use, we have an individual that's developed something that essentially will read an email and determine, is the person happy? Are they sad? Are they evasive? Are they nervous? And it's amazing what you can glean from reading the email for tone rather than having to actually you read the email yourself. So as Bill alluded to again earlier, we can start to use the evolution of technology, the advances in technology, to help us become more effective, and we can see when the tone of the conversation changes. That way we can go ahead and be very proactive as it relates to our fraud prevention efforts. And then finally, simply looking at what are people talking about. We've already talked about who are they talking to, how are they talking, now what are they talking about, and topic mapping is very important for that. And these are actually word clouds from two different finance departments, and I'm going to go out on a limb and say you can all probably figure out which one had a problem. Anytime we see monkey and struggle within our finance department's communications, we probably have something we need to look into. And topic mapping and watching the evolution of the topics over time can really help us pinpoint something before it gets out of control. So with that, I'm going to go ahead and talk through just a few different ways that we can detect fraud through analytics. First and foremost, as we look at the anti-fraud controls and the effectiveness of those, proactive data monitoring and analysis, so essentially data analytics, is right at the top of the list. As it relates to the median loss, it's a reduction of nearly 60%. It's hard to argue that that's not effective. If we look at it from the median duration standpoint, so how can we make frauds last less long, shorter duration, again, data analytics is right up there near the top. Now, I know we have a lot of external auditors on the call, and I do want to point out that an external audit is actually near the bottom of the list on both of these, and I think everybody knows why, but I do want to make the point. As it relates to fraud detection, we're talking about anti-fraud controls outside of an external audit. External audits are obviously designed around the materiality of the financial statements. Are they materially correct? Not designed with the full intent of detecting fraud. So that's why those show up near the bottom here and why we're not really focusing on the audit approach, but more so how can we use analytics in our organizations for this. With the advances in unstructured data, structured data, visual technologies, and everything that we have available, we really need to start tackling all aspects of the fraud triangle. Not only the accounting system and the actual fraud itself, but if we really want to be preventative, we need to start addressing pressures, rationalization, and opportunities, and using all of our data in our risk assessment to do so. And finally, as it talks to the fraud schemes, Carolyn is going to jump on here and talk to us a little bit about financial statement fraud. Patrick here in just a bit on asset misappropriation. One thing I'd like to point out, if we look at the most common fraud schemes, corruption is rampant across the board. Anytime you have corruption that's rampant across the board, across all industries, you know you have to use something, and data is really going to be the best thing to do that. So we can look at these patterns, we can start to identify those things. Now, Carolyn and Patrick have some great examples that they're going to walk us through as it relates to finding different types of fraud. And I'm going to pass it over to Carolyn Newman first. And Carolyn, let you start talking a little bit about financial statement fraud and moving from ad hoc to continuous monitoring.
Thank you, Jeremy. And I really like your fraud triangle that takes into account the data sources, because that really drives home the need for data analytics. What I'd like to talk about today on moving from ad hoc to continuous monitoring starts with a story. A few years ago, one of our clients, a CPA who had not much experience with IDEA, sat down with a client and asked him some questions about his accounts payable function. How many people were in payables, what was their longevity, how long had they worked there, and was the data available electronically for him to review through cash disbursements and accounts payable. So he got the cash disbursements records for a 6-year period. Not knowing IDEA too well, he went, let me just summarize the amounts, the check amounts. And so he sat down with the CFO with this list of amounts and saw 45 instances of the number $1,264.51. Well, the CFO was like, he couldn't think of anything that would be that odd amount that many times. And there were several other examples. So they went to the bank and they pulled the information from the imaging system and were able to find out that a AP clerk who had been on board for several years had been able to divert $860,000 over the 6-year period into her own account. And she did it by some of the things Jeremy mentioned with vendors that had gone inactive, where she was able to change the address, and some other ways. But this is an example of a basic use of data analytics. It's one test, one time, to point you to something. And we can see that the risk assessment, the fraud risk assessment that Robert did, was basically asking some questions about, where are some possible exposures in payables. In his history, he knew that longtime employees often become trusted and have access beyond what they should have. So he was able to do one test and find all this fraud. And he got a client for life. His firm began using software more frequently and on all of their audits. And that would cause a firm to move to the application of analytics. Application of analytics, to me, refers to a group of tests that could be performed by area. They're not really automated, but definitely more sophisticated than the one-off tests. Examples here are tests of controls, fraud tests for a scheme that might be identified in the fraud risk assessment, and then applications found in Smart Analyzer, a part of IDEA that we'll discuss shortly. I want to pause here and tell you that as a representative for Caseware Analytics, we are the distributor for IDEA. We support it and help hundreds and thousands of clients across the country, do data analytics in not only financial statement fraud areas, but areas where they just want to help their clients get more information and have actionable areas to improve their operations. Now let's move on to the area of managed fraud detection. Managed fraud detection takes the application of analytics and moves them really from an audit function to a management or operations area. A good example of this came from one of our clients who was the internal audit department conducting annual I'm sorry, I went too far there. Conducting annual T&E reimbursement audits. So they go in every year, and they always have findings. And the AP department is like, okay, we try to improve our controls, but things keep happening. And they realized that they needed to really get there first. They needed to be looking for this, monitoring the exceptions as they came across. So they actually acquired the software and the analytics that had been developed, and they were able to, with very little training for one clerk and a very nice bonus program, catch things as they were occurring or shortly after so that they were able to do something about it. Now, what that does is that moves the area from a fraud detection to a fraud deterrence. Because believe me, when someone is asking every time reimbursement requests are put in, if anything looks odd, the word gets around. And so we definitely moved from a fraud detection to a fraud deterrence activity. Next on the continuum is automated and repeatable results. Now what this means is when you've identified tests that work and things that you want to be tracking, this leads towards continuous auditing, if you will, then that allows it to become rather not so much a tool operation as a system, because it can be automated. Where it's useful to do this is where there's high volumes of transactions, where the rules and the logic that needs to be testing can be standardized, and where the results can be passed off to others who can be looking into them and turning them into actionable items. These automated repeatable tasks usually are performed by internal audit, which leads to continuous auditing. I think there's probably some external audit firms that are dabbling in this as well. Then the next thing that happens is the repeatable tests and the automation branches out and goes basically corporate-wide. So we end up with the enterprise-wide continuous monitoring. A thing to realize is that the continuous monitoring really helps improve your control environment, but it also provides for insights that can go back to the business so they can deal with the root cause analysis, find out ways that processes can not only be improved from the control standpoint, but from an efficiency standpoint as well. So there's really lots of extra benefits to going to continuous monitoring through the use of analytics. Because so much of what we're talking about is a tool-based technology, I wanted to tell you a little bit about the IDEA process. Now, this could also be called the data analytics process because it definitely is something that is done even when you use a tool like Excel. You have to get the data. You have to make sure that the data you got is right and that it is clear and able to be used. Now, after the data is in and reconciled, you're able to perform analytics. The analytics can include everything from the simple summarization that I told about to aging, duplicate detection, joining fields together from separate files for further analysis, and even a little bit of visualization. Afterwards, you can report in a number of ways, from pivot tables to charts and exports to other applications. Now, this process, once it's defined as something that is standard that you want to do more often than a annual basis or a quarterly basis, that's when you take a look at, is this something we want to automate? I wanted to let you know that in IDEA, there are some apps that are pre-developed tests that are especially useful in the area of fraud detection for financial statement manipulations. In this case, we're showing the General Ledger app. Notice that it has a list of the fields that would be used in all these tests. And part of the app is to formalize your data request. So you actually choose what test you want to do, and then you create a report that identifies the fields that would be needed. After all, if you don't have all the data that you need, you can't do the tests that are listed in the area. Now, specifically for financial statement fraud, I'd like to just briefly go through what I think are 5 of the top and easy to do tests that can help you look for this sort of thing. The first one is summarizing transactions to find anomalies. In our story earlier, we just summarized one field. You can summarize more than one. This is an example of the General Ledger transactions, and it shows the account number, the account description, how many records there were, and then the total for the debit and the credit. The reason this is good for financial statement fraud detection is because often when people are cooking the books or trying to beef up their results, they will want to maximize their revenue and minimize their expenses. And so if you're looking at expenses, you should question why there might be excessive credits. I mean, are all our vendors so bad that we have to get refunds from them? And notice here that we have an odd amount, $485.71, in several different accounts. Why in the world would that be? So you can see by doing this simple summarization of transactions, the anomalies come right up. The anomalies come right up to your attention, and you're able to go and do some further investigation. The next test is one that is so simple in IDEA. You import the data, and it lets you calculate field statistics. Now, field statistics are available on numeric fields, date fields, and time fields. In this example, the dates you can see are for more than a year, so that helps you find out that you might have the wrong population. But it also counts up for you when transactions occurred. And we can see here that we have some transactions on a Sunday. So we may want to click on that blue 2 and drill down and find out exactly what those details are and investigate and ask the client why they were doing entries on a Sunday. The next analysis that is just a lot of fun and visually appealing is Benford's Law. Don't have time to explain the theory behind Benford's Law. I think Jeremy's a bit of an expert in that area. So if there's time, I think I'll get him to tell you his story. But the point here is there are expectations, according to Benford's Law, of what the digits are in a set of numbers. And in this case, we're looking at the credits in the General Ledger, and we have drilled down on the 48 as the first 2 digits. And there you can see there's our odd journal entries, and look what the code is, correct coding. Why would we correct coding to that many different accounts in the exact same amount? So you can see this brings to your attention exactly what you need. And I like how this screen not only points out some anomalies, but emphasizes for you the ones that are suspicious, highly suspicious, and regularly suspicious. Next, we have round numbers. Round numbers are, if you would round it off, in this case to 3 zeros, all numbers in the thousands will come to your attention. Look at the bottom here where you see the $15,000 against printing. That was one of the odd amounts. I believe the credits to printing on the first slide were $15,485.71. So here we can see all the ones that we should look at because someone maybe in their cooking of the books has been lazy and just rounded numbers. Or maybe you're looking at some estimates, some accounting estimates often are round numbers, and this would find those in where they would have been recorded. Finally, the search function lets you look for odd descriptions and comments in a field. You're most often going to be looking through general ledger data, but also you should look for sales transactions and payables, especially payables after a time period, so that in case the company was holding back payables to limit their expenditures and lower their expenses and raise their profits. In this example, this is from an actual case where the company was acquired and the original executives had been cooking the books for quite some time. The auditors, the due diligence people, the bankers, nobody caught it. Finally, when the company ran out of money and they had to go into receivership, the forensic accountant discovered that a term, credit to clear, had been used to basically reinstate bad debts and add false revenue to the company's books. And so they were able to quantify it all just by entering the credit to clear and searching through the memo field. By the way, the impact of that one financial statement fraud on a private company was $18 million. Just a quick review of the test that we showed you. There's summarizing transactions to find anomalies, transactions on weekends, Benford's law analysis, round numbers, and searching for odd descriptions. Now that we have some analytics and some things we want to look at, it's important, I think, to recognize the times when we should move to continuous auditing and continuous monitoring. And there aren't a lot of examples of continuous auditing of financial statements other than monitoring of general ledger journal entries. And I will give you a little case study right at the end. But I just wanted you to be familiar with the process. Basically, the data goes in, and that's automated. It goes into the Caseware Analytics platform, and that's basically powered by IDEA, though it could be powered by scripts and analytics that you've already written in Excel, Access, SQL. So it will take application analytics from other sources, and then it spits out the exceptions. The important thing is not to let those exceptions pile up. So they need to be regularly remediated, and this next slide will show you the process for automating remediation follow-ups. It's very important, especially if you're highly regulated, for you to document that you have been monitoring for the violations of the different regulations. In particular, Foreign Corrupt Practices Act comes to mind. That you will assign the errors, the exceptions as they're found, and those will be marked as under investigation, and then the process will involve either escalating them or going to review and then closing. But it helps you document every step of the way, because that will protect you by showing that you have got something in place to be watching for those types of violations. I want to close with a little case study. This is an example of continuous monitoring that is being done for a company on manual journal entries. They have determined, the company knows that that's where their exposure is for financial statement fraud. And so they get a dashboard by whatever period they choose that will show them the percent of manual journal entries compared to automatic journal entries. And so this is a way that the management can monitor what's going on, and they may choose to investigate further whichever locations are pointed out to them visually that there may be a problem. And I think we're ready for some poll results. Is that right?
Thank you, Carolyn. I appreciate the insights. We're going to go ahead and look at the results of polling question number 4 to see of the audience who all is using analytics to detect fraud currently. Looks like we've got about half the audience, right at half is currently using analytics to detect fraud. About a third are not. And then we've got a few that aren't sure exactly what the approach is. Bill Pollard, I would be curious to get your thoughts on this, with about half the audience using analytics for fraud detection.
So from what I'm seeing from companies that we're interacting with, it doesn't surprise me. I think some folks might even maybe not realize that they're using analytics. Maybe it's not just in the way that we described it here today, but they're using some things with Excel and pivot tables within Excel, or maybe our internal audit colleagues out there are using tools like ACL to do some tests that we would absolutely call analytics. But with that said, I think this is really still an evolving area. I think there is so much opportunity for companies to realize, as Jeremy and Carolyn have talked about, the power of analytics and the capabilities to enhance your fraud fighting activities, that I would not be surprised if next year, if we ask the same question, you would see the yeses go up significantly from where they are now.
Yeah, I agree. I think you nailed it right on there. And like you mentioned, a lot of people probably are using some type of a tool. Maybe it's Excel or Access. They just don't necessarily consider it analytics, but in fact they are. But in any event, with about only 50% saying that they are, that leads us well into polling question number 5. And polling question number 5 is on your screen now. And the question is, what is your organization's biggest challenge to implementing data analytics? We've got a few choices for you here. We have personnel, resources, time, expertise, not sure, or we don't really have any challenges. We're pretty well right on point with analytics. So again, what is your organization's biggest challenge to implementing data analytics? Personnel, resources, time, expertise, not sure, or no challenges. I'll give you just a few more seconds to go ahead and answer that question. And we will revisit the results of this poll in just a little bit. Right now I'd like to turn it over to Patrick Taylor to talk to us a little bit about the other types of fraud detection out there beyond financial statements, the asset misappropriation and corruption frauds of the world. So Patrick?
Okay, thank you very much. Excuse my voice a little froggy today. First thing I want to start out with is to give you a real-life example of a fraud that we uncovered. We call it the art of deception. And then further to make kind of the point of why you should care about finding something like this. So this was at an analysis we did for a new client. We did looked back through a few months of data and uncovered this interesting thing. One gentleman, every time he traveled, he expensed a Spa Paws hotel. Now, obviously, from the spelling, you and I looking at it, that looks a little odd there. But what we were able to find, the clues we were able to find from the analytics were the fact that every time he traveled, he expensed Spa Paws hotels and also another hotel. So it's sort of an odd pattern of using that hotel. Now, another clue that was available was on his expense report, he concatenated the words. It was all one continuous word. The second P wasn't capitalized. A little less obvious what you're looking at there, but the data that came through from the credit card company, so in the actual transactions, had it spelled as you see here on the slide. And those two things look different, right? So there is another clue that perhaps something is going on. Now, what we noticed happening in the data, again, over time was there began seeing also spa pause taxis. And the spa pause taxi, again, had it spelled the wrong way or concatenated there. You also had the fact that there was airport parking and mileage being expensed and a taxi always in the home city. And again, other pieces of clues, other pieces of evidence that show a pattern of, in fact, what was happening here was very much against company policy, and it's probably obvious to all of you. This gentleman was expensing his dog's stay at a kennel every time that he traveled. And in fact, it ended up being quite a nice kennel and not a taxi, but almost more of a doggy limo ride. And it was to the tune of about $12,000. So, significant hit. But when they started looking into him, here's what they found, which was really even more telling. They realized he had sold over $200,000 worth of company equipment on eBay. And for those of you ever wondering why people have printer cartridges available so cheap on eBay, many of those, in fact, are coming from the company supply shed, but this, or supply closet. But this guy had obviously hit them up for a very large amount. And essentially, this proves the point. The ACFE, the Association of Certified Fraud Examiners, commented or observed that 3/4 of the time, if an employee is committing expense report fraud, they're also engaged in some other form of occupational fraud. What we're really saying here is you want to kind of look for these people, even if they're not hitting you for big dollars on expense reports, because these probably aren't the kind of people that you want to have working at your company. Now at Oversight, we offer, again, something similar to what Carolyn talked about, but in a sort of a different format. And here's a number of the companies that are working with us to do a better job fighting fraud with less effort. But what we're providing for these companies is kind of more of a turnkey package. So we bring the data assembly, the analysis, all the workflow capabilities, sort of the managed fraud detection service that Carolyn pointed out, the automated repeatable processes there. We provide that in a software as a service capability. It's a very turnkey product offering. So we're going to do all the work for you and basically provide you the analysis, provide you the answer. So for people that are busy or you have a lot of analytic projects to tackle, what we provide is a way to get analytics in some specific areas, and I'll explain what those are, in a very turnkey fashion, something that's our strive is to make it as easy as possible for you and to help you do a better job. So let me tell you where those areas are. We have the services, we call this Insights on Demand, for purchase card, travel and expense, and procure to pay. And in each of these areas, we have the analytics we believe you should be running. So in essence, we say, this is what you should be looking for in travel and expense. This is what you should be looking for in procure to pay. This is what you should be looking for in purchase cards. Now, travel and expense is featured a little more prominently here for a very explicit reason. It is by far the most common place that we start with customers. And there's several reasons for that. One, it's where you believe people perceive and actually they do have probably the most risk because it's the least controlled business process. You got a lot of people out with the ability to spend the company funds in relatively easy ways to try to beat the system and try to cheat the company. And also, of course, it's an area where we can see some waste as well. So much like when Carolyn or others talked about earlier, you're going to drive some business process improvements as well when you do a kind of analytic project like that. So travel and expense ends up being the most common place for us to start with customers, and then we'll usually migrate into one of these other areas. I mean, we're happy to start with any of them, but again, that's the most common pattern. Now, let me explain in a little more detail exactly what we're doing under the covers here. So the first thing, as I mentioned, is we do the job of data assembly. We curate all of the data for you, and we believe it's very beneficial to cast a very wide net. So when we're doing this, we want to pull in the data from your card company, whatever kind of corporate card you have, American Express, Visa, MasterCard. We'll want to pull in data from the ERP system, usually HR type information, as well as from your expense report system. And in particular, if you're a Concur user, we have a connection into the Concur cloud, and you can click a couple of buttons on an administration screen, and generates the security tokens, and we can automatically pull the detailed travel and expense data into our cloud and assemble it, get it ready for analysis. Now, kind of going up the right-hand side here, there's a couple of interesting places where we actually augment your data with other information to help with the analysis. So one example is the geocoding information. And my favorite one to talk about is we have a database of addresses we've assembled. Now, these addresses are kind of interesting. If many of you may know, your average gentleman's club doesn't come through on a credit card receipt as the Cheetah 3 or whatever. They typically come through with some kind of restaurant name, Bubba's Barbecue or what have you. Most of them have a restaurant, and they find it's easier to get their charges through expense reporting systems if they bill as a restaurant. Now, what you can find, though, is at the level 3 level, at the greater detail available in the level 3 information from credit card companies, is the actual physical address of the establishment. So we've assembled a database of all those physical addresses. We'll match on that against what we see from your credit card feed and identify places where, in fact, that wasn't the sales team going out for a big barbecue dinner. That was a sales team going out for something that's perhaps more inappropriate, that's against your company's policy. Finally, the top thing on the right is benchmarking information. So we have data from billions of dollars in transactions from a number of companies, and use that to generate very detailed statistics. Because one of the things you're trying to look for when you're doing analysis is finding things that are unusual, that are anomalies. But let's think about that. It can be a challenging problem. In, let's say, New York City, what's an unusual amount to pay for a hotel? Well, that answer changes. That answer is different in December than it is in March or February or in June. Prices go up and down. So we have the kind of statistics that let us know when something is a very unusual hotel charge in December versus another time of the year. Similarly, for those of you concerned about Foreign Corrupt Practices Act type analysis and covering your risk there, the Foreign Corrupt Practices Act says you can entertain politically exposed persons, but it has to be in a way that is normal and customary for the specific place where they are. Well, again, that introduces this interesting question of what's a normal and customary lunch in London is very different from what is a normal and customary lunch in Bangalore. Those are just different amounts, and you need to have this kind of statistics to flag the specific transactions where you could, as an example, have a Foreign Corrupt Practices Act risk. And so we bring all of this information together and do that as part of our service. Now, next, we do a lot of detailed work with a lot of complex analytics. Again, many of the techniques have been cited earlier, or the type of things our data scientists apply to your data. So after we've assembled the data, we'll go through and apply statistics, do aggregations, do analysis of the text, find unusual formatting, do link analysis, do basic Boolean logic. Basically, we will do whatever kind of analytic technique we think it's going to take to help us find clues, to help us find evidence. Now, the trick for this, and this is getting a little deep under the hood, but I think it's worth understanding, is how do you deal with all of the results from all these different tests, from all these different analytic techniques. So the heart of our system is something called evidential reasoning. You don't need to worry about that too much. It's an artificial intelligence technique. But what it's doing is it's an approach that says, when I'm looking for something like fraud, I'm looking for needles in a haystack. There's no one magic test that's going to absolutely identify the fraud. And in fact, what I need to do is apply a number of tests, look for a lot of different clues, and then weigh those all together. So much like your favorite TV crime scene detective pulls together the story by assembling a number of clues and bringing those all together, evidential reasoning is doing that same approach here. So as we look at your different types of data, we apply the different analytic techniques, and again, many of those will check out okay. Some will, in fact, turn up clues, turn up problems that we have found. And each of those, we apply a weighting. So there may be some clues that just give us a little bit of more confidence that we found the problem, and other things that we give a high degree of weighting to. There can even be conditional things. The fact that something's a manual journal entry isn't necessarily by itself a problem. It's only a problem if it's also done on a weekend and it's for a round dollar amount or things like that. So you can have, in fact, even some complex conditioning of this is only an issue if I see something else. So what all this does is lets us generate specific insights where you know how confident we are about what we found. And another output of this is we'll actually be able to explain in plain language, here are the 5 clues we found that made us think there is a problem, there is a risk with this expense report, with this employee, etc. So the analytics are very complex, but fortunately come through and explain to you in a very relatively straightforward, easy to understand way. You'll know why we've found problems. Now, one of the important things we believe you can do and should do with technology is kind of look for patterns through time. These are the kind of things that even if you are auditing expense reports or purchase card transactions manually, it's hard for any human to catch a pattern over time. But much easier to do that with an appropriate analytic capability. So as an example, most companies have a receipt threshold of $25. So anything below $25, I don't need to keep a receipt. Well, we'll look for a pattern through time of someone who, every taxi, every meal, every breakfast, on every trip, they're all coming out just statistically too close to $25 to make sense. And when you see enough of that pattern over enough months, it gives you a reason to dig in a little deeper. And you're often in these going to find where somebody is, in fact, sort of gaming the system. Now, maybe this isn't something that you worry about firing someone, and you worry more about trying to influence their behavior, trying to get them to do something more appropriate. But again, this is the power of what you can get with an analytical approach with the computers and software that can, in a sense, remember things and see patterns over greater time length than any of us can as humans. Now, as everyone talked about before, we are, in fact, a lot of ways looking for needles in a haystack when we're trying to find fraud and even when we're trying to find waste and errors. And so we view the job of analytics is to go through the haystack and get you to a small pile of sharp things, and then we bring a human into the loop where a human can bring their final judgment and look at this handful of sharp things and identify the specific needles. So in our case, that comes to you. You see that in the form of a case management user interface with workflow capabilities and communication capabilities. I'll talk about those in a little bit more. And an important benefit we get out of watching the users resolve the things that we found is it gives us an opportunity to apply some guided machine learning techniques so that we can make the analytics smarter. So the longer you're using the system, the smarter their analytics going to be just by paying attention to what's happening, what you're doing, and how you're resolving things. And then finally, we also present the information in benchmarking. So not only benchmarking on how many problems were found, problems available by different business units, et cetera, so sort of slicing and dicing your information at a dashboard, but also can give you broader statistics on how your spend is being allocated across different type of merchant categories, et cetera. So basically, once we've gone through all this effort to assemble the data, to apply these analytics, there are a lot of rich and interesting insights that you can make available through a dashboard, which we've talked about earlier, is important when you come to thinking about communicating with others on how the program's working. Now, I mentioned there's a communication capability built in, and specifically, by that I'm meaning email, because what we found, what our customers tell us is, yes, it's good to find the fraud and to take the appropriate HR actions, but there's a lot of business value that can be driven by really influencing employee behavior, by taking care of those again, not fraud, but events that are happening where people are not paying attention to company policy. We're doing out of compliance behavior. And what we're able to do and what our clients find very useful is, in fact, to automate the communication with various employees and their managers about transgressions. But an important note here is what we found to be much more effective, as opposed to emailing someone saying, hey, there's a problem with this expense report, to instead look for the pattern of activity over time and come instead to someone and say, we found these 5 problems in last month's worth of expense reports. What's happening there is, A, you're showing them their pattern. B, frankly, it's a lot harder for them to explain it away. And that ends up influencing their behavior. And again, this can all be automated. You can ask people to reply, and we'll track whether or not they reply. And again, everything is logged so that you have proof on what happened, and you can certainly see if there's a bigger issue that, month after month you've got the same person having the problem. We'll notice that as well, and perhaps it's time for a meeting, et cetera. But this ability to communicate, influence behavior is actually one of the things that drives the really large dollar savings. So, I mean, fraud, very frankly, will be a small percentage, very small from a dollar percentage standpoint. Again, it's helping you find the bad apples, the kind of people you probably don't want working at your company. But driving compliance with travel policy, that'll save anywhere we find from 3 to 5% of your overall travel budget, which for most companies is very significant dollars. So in this process of looking for fraud, we can also drive tighter behavior and save some fairly significant money. So let me go over a couple of case studies. One, this is a large industrial company I promise you've all heard of, but as I go through the example, you kind of understand why we keep it anonymous. So they reduced the effort they were applying to looking for fraud by 6/7. So they had, 1 out of every 7 people. They had a team of people before using BI tools trying to look for fraud. Effectively, they were looking at about 20% of the expense reports is what they affected. Since they've adopted Insights on Demand, they have a much smaller team. And what this team does is they just look at the handful of exceptions that we identify through our analysis. So as opposed to having to look at, trying to look at 20%, they're frankly looking at a single-digit percentage of expense reports. And further, they actually eliminated manager approval for all but the largest expense reports. So the 10% largest from a dollar basis, they still have to have manager approval, but everything else goes through automatically paying. And when the program director was explaining this, someone in the audience asked her, well, how do you know you're doing a better job? I get that you cut the workforce by 6/7. You eliminated manager approval, you're paying employees faster, they're happier, but how do you know you're doing a better job? And her answer kind of surprised all of us. She goes, well, let me tell you, and she goes, this is the statistic I look at. We went from firing about 1 or 2 people a year to we're firing 1 person a week. And she goes, we're not firing people for upgrading to a Cadillac at the Hertz counter. We're firing people that are really cheating us. We're firing people that are gaming us in any number of ways and flat stealing money from the company. And again, those aren't the kind of people we want working at our company. Now, another example case study we have is from Kimberly-Clark, and they use us both for Insights on Demand, both for travel expense and for their purchase card program. It's sort of interesting as to how that evolved. They realized that once they started enforcing policy more tightly on one of those programs, they were frankly going to, if they didn't watch it, drive the non-compliant behavior to the other program. So they really looked at it. In both places, I've got employees with a high degree of discretion in what they do. I really need to think about how do I enforce our policy and how do I guard against fraud on both of those so I don't drive the problems from one place to the other. So their view is they've cut the effort they're putting into this by over 60%, so it is easier for them. They've increased the scope. They were, again, another company doing what seems to be typical of auditing 20% of the expense reports, and they now added another 80% to that, so effectively we're auditing all of them. And what's been interesting too, and this is an example of how the communications can drive behavior, is they have dropped their policy violations by 70%. So it's kind of the old adage, you get what you measure. And if people know you're paying attention to how they're complying with policy, obviously the people you communicate with will most likely correct their behavior, but very frankly, the word will spread. They're going to tell their friends, hey, there's this oversight systems. It's actually quite interesting. We will see random employees show up asking for pilots from some of our customers, and we've identified the pattern as what's happened. There's someone who have been uncovered by oversight systems, and then they come to us to try to figure out what's happened to them. So we politely tell them, oh, it's okay, your company already uses this, which we're guessing they already knew. I want to point out a couple of resources we have available. So we have a spend analysis report. We do it every year where we kind of dig into the details of how people are the spend across the billions of dollars that we look. So again, statistics across all of those, and give you some ideas of where common problems are, what percentage of people are really causing a problem. It's one of those classic examples, by the way, of it's relatively speaking, a small percentage of your travelers are causing most of your problems. It's beyond the old 20/80 rule, quite frankly. And that's actually the good news, because if you can find those and identify those, it's relatively straightforward to influence them and frankly, massively improve the compliance of your program. In our spend analysis report, and we're about to publish the 2015 version as well, can give you some ideas about how all those numbers work. And then the other resource we have available, and both of these are on our website, is a white paper by Michael Rasmussen of Corporate Integrity. So he's a well-known industry analyst around Foreign Corrupt Practices Act. And so this is a white paper on how to use monitoring and why you should be using transaction analysis as part of an anti-bribery and corruption program. So both of these are available at go.oversightsystems.com/FEI. So please come by, download both of those. And we'll now turn it over. Back to you, Jeremy.
All right. Thank you, Patrick. I really appreciate those insights. I think all those case studies very insightful, gives us all some great ideas. And what we're going to do is we're now going to take about 3 or 4 minutes for each of the presenters here. We're going to go over a call to action and some best practices. I think one of the most important things that can come from today's webinar is that each and every attendee has something that they can take back to their organization and really put to use. So I'm going to start off here with a quick call to action, and I think that there are really 4 things that jump out to me as critical next steps and things that you need to be thinking about as you go forward from this webinar and start to use analytics more proactively within your organization. First and foremost, just think back through all the examples, all of the different types of analytics, the case studies that you've heard over the last hour and a half, hour and 40 minutes, and figure out what is that one thing that really resonated with you, and think really simple. Start there. It's going to do a couple things. One, it's going to allow you to get a quick win, and it's going to help you kind of get the ball rolling. Second is be willing to think creatively. I know we're all in the accounting industry. Creativity, probably not the most encouraged characteristic in our industry. But I think as it relates to fraud detection and prevention and analytics, we have to be incredibly creative, because those that are gaming the system, as Patrick and Carolyn just talked about, they're being creative, so we're going to have to be too. Another thing that I'd like to make sure that you keep in mind, I said start simple, something where you can win quickly, is don't be afraid to fail. It's okay to pick an analytic that doesn't work the first time. If you pick something that's simple where you can win quickly, the great news is you can fail quickly. Learn from that and then build out a better analytic for the next time. And probably the most important next step that you can take is to do something. Take something that you have learned over the last hour and a half, hour and 45 minutes, and be sure that you put that into practice when you get back at your organization, as soon as it's over, or maybe even tomorrow or later this week. Some resources for you that can help. Patrick has given some. I think Carolyn and Bill have mentioned resources, and will as well in the future. Some resources I would recommend. These are all 3 books that I'll throw out there. Data Fluency is a wonderful one on visual analytics and the use of data as a visual medium. Forensic Analytics by Mark Negrini is one of my favorites as it relates to getting started with analytics. Benford's Law is in there. As Carolyn mentioned, I'm a pretty big fan of Benford's Law. There are lots of great applications and how-tos in forensic analytics, as well as data points, which is all about using your data. The other place that I would encourage you to look for resources are all of the software companies out there that are trying to get you to use analytics, because you're going to have some great case studies, as Patrick and Carolyn have shared from their companies today. Look at the accounting websites. As Bill mentioned, there are a lot of case studies there. I know we have case studies at bkd.com, and the other place that I would encourage you highly to go look at is the ACFE. The ACFE has a lot of great information on fraud prevention and detection. All of the sponsors of the anti-fraud collaboration are going to have materials, so be willing to go out to those websites, get the resources. The big thing here is to get ideas, because once you have the ideas, you're going to be able to go back to your organization and put that into practice so you can actually start building out some analytics for fraud prevention and detection. Now, as it relates to best practices, again, as I said, we have about 3 or 4 minutes for each of the presenters here, and I'm going to start, Bill Pollard, with you. What best practices and proactive measures would you recommend?
Sure. So thanks, Jeremy. And when I think about taking what you just said and expanding on some of that a little bit, you just mentioned the ACFE, for example. If you follow the statistics that the Association of Certified Fraud Examiners puts out annually, I mean, they represent that their study, as indicates, 4 to 5% of revenues of companies are lost due to fraud on an annual basis. Whether or not that number is actually the right number or the right number for your organization, I think the key is recognizing that fraud happens, that it does exist, small companies, large companies, public and private, and that a company has a responsibility to recognize and to address that risk. There are a variety of different ways of doing it. We've talked about things like the fraud risk assessment, and we spent quite a significant amount of time here on actual techniques to address that. But what I continue to see more and more that companies are doing, they're actually putting in the focus for their organization to put them in a position to address the risk and attempt to mitigate it. So that includes things like actually developing a fraud policy for the organization, developing an investigation program for an organization, and how do we go about investigating fraud when it's brought to our attention. To better coordinated efforts between those who have responsibility for detecting and investigating fraud with those individuals in the organization who have responsibility for monitoring and ensuring compliance within the organization, so that all of those groups are working hand in hand. That when a fraud is detected, that there are those within the organization who can come in behind and make sure that they understand the controls that existed or didn't exist potentially that allowed the fraud to be perpetrated. And then having the other function, the compliance function in the organization, step back and take a look at what are we missing that has allowed the fraud to have existed in the first place. Is this a training opportunity? Is this a policy opportunity? What may be missing from that perspective? So putting in those types of functions within companies to help address that risk. Additionally, training on fraud. There's different schools of thought on whether or not and to what extent to train employees about fraud and fraud risk. I'm of the mindset of training is imperative to mitigate the risk. There's certain individuals that might get concerned that what you're doing is arming your employees so that they now know better how to commit fraud, when actually the opposite is what takes place. You've now just armed, the hundreds, if not thousands, of folks in your organization to be additional eyes and ears for you to be able to look out and help you to address that risk. And then, as we've spent a great deal of time here in the discussion, really proactively mining for the risk of fraud, building some type of analytics into your compliance, your audit, your other monitoring related activities, so that you are taking the risk seriously and making sure that your organization is doing as such. So those are just some of the thoughts that I have, Jeremy, that I wanted to share.
I appreciate that, Bill. Thank you very much. Carolyn, what are your thoughts on some best practices to help people get started here as a result of the webinar?
I think education is really number one. Get some training or some knowledge about fraud and the fraud schemes that are out there. There's lots of really good books. The Benford's one that you mentioned from Mark Negrini, there's actually a chapter in there about financial statement fraud. And it's got ways that you can monitor or analyze financial data from different organizational locations. So like if you have branches or divisions, you can get all this information and do a analytic on the numbers that are coming in and find those anomalies. Always be looking. It's not just the pervasive all the way up to continuous monitoring, but even the ad hoc. If you had continuous monitoring implemented and it was running very well, you still would want to be able to do some ad hoc work, because things change and you need to always confirm that those fraudsters haven't found another way to do something bad. I think, again, the professional audit tool and the proper training for it, understanding your data is very, very important, I think. If you can't get the data, then you can't do the analytic. And in some cases, you may want to do a internal risk assessment. Do I have the right system? Am I capturing the data that needs to be monitored? Because if it's not captured, then it just kind of goes into a black hole.
Right, yeah, it's kind of hard to start using analytics, data analytics without the data on which to apply the analytics. That's very important. Thank you, Carolyn. Patrick, what are your thoughts here on best practices?
One, and I'll echo this, get started. And a common thing we run into are people concerned with, well, gosh, it's going to be all this much more work, or I'm going to have to look at everything. And part of it is say, any of our analytics are going to produce a lot of potentially, or produce some interesting things to look at. If you look at the highest risk ones first, you're still better off than where you were when you weren't looking. So don't get too wrapped around the fact that that I may not have the time to look at everything I found. And the other thing we find people is very useful is, if you're thinking about doing, when you do random samples of things, so expense reports, most of the time you're looking at false positives. The things you look at are perfectly okay. And where you can use analytics is, if you apply that same time you were spending on random sampling to instead looking at things that were identified as risky, you have a much more productive use of your time. And I very much agree with what Carolyn just mentioned, that there is a very complementary between continuous monitoring versus ad hoc. I had an internal audit director once said that the way he looked for technology such as ours that were doing this routine recurring analysis is that was freeing him up from doing that, which gave him more time to think about the new risk, the unknown risk, the kind of things that you can go need to discover on an ad hoc basis. So I'd really agree that there's differing roles for systems such as Insights on Demand versus using some kind of ad hoc tool, because what we're going to take care of is the regular risk, and it gives you, again, time to go out and explore more. And I think finally the other interesting thing is selling this to management it isn't always just pinning it on fraud. The process improvement, the controls improvement, the policies improvements that you can drive out of these are a number of dimensions of value. So whether that's driving out waste or figuring out ways to make your travel policy work better for employees, all those are value add above and beyond the fraud that you may find. And the other thing I'd certainly always emphasize is that it's worth it to find those few fraudsters. Hopefully most companies have very few of them, but in no case are these the kind of folks that you really want working at your organization.
Right, I agree. I really like the value add. I mean, it's amazing how much value using analytics can add just beyond the initial objective. I think that's a great point. Thank you, Patrick, for that. I'll close with one quick thought, and this is one that I think is very true, that if you're willing to use analytics to improve your top line, you should most definitely be willing to use analytics to protect your bottom line. We see analytics used day in and day out in the marketing department. I'm a big believer that it's time that we bring that in-house to the accounting department, internal audit, external audit, whatever the case may be. But analytics is brought to the accounting department so we can actually help to protect that bottom line against fraud, waste, and abuse. I think collectively with the other presenters today, I think we've shared a lot of insights to help you do that. And with that, I'm going to turn it back over to Bill Sinnott for some closing comments and polling questions and let you go from there. Bill?
Hey, thank you, Jeremy. First of all, I want to thank our panelists today, Jeremy Clapton, Carolyn Newman, Bill Pollard, and Patrick Taylor. You've all provided some great insights, kind of tying everything together for us. And now we have the results of our last polling question. We see that most companies have challenges in resources, with expertise, which is related to resources, shortly behind. So I think the story there is companies are constrained with resources, and they're trying to figure out how are they going to do this data analytics to prevent fraud on top of everything else they're doing. So that's kind of an intuitive response to the question. We have some time now for we have our final polling question, and here the question is, do you currently use continuous monitoring software for data analytics? And the possible responses are yes, no, or not sure. And we'll give you just a minute or so to respond to that. And while we're waiting, since that polling question was about continuous monitoring, we do have a number of questions related to continuous monitoring from our participants today. And I'm just going to take a moment to say that several years ago, FERF did a research report on the benefits of continuous monitoring. It's available at www.ferf.org/reports. And so this first question would be for Carolyn. Carolyn, can you describe where data is truly sitting in continuous monitoring, and how does it relate to tables that can be compiled by the system? Obviously, this person is not quite sure what continuous monitoring is because the data is really your ERP system data. But Carolyn, why don't you explain a little bit more where the data is that you use in continuous monitoring?
Yes, I'm happy to. In continuous monitoring, at least with respect to the Caseware Analytics platform, it's a box, it's a server, it can be virtual, and the data resides in there after it has been acquired and processed. So it's like a data warehouse, if you will, that has the information that has been brought in so that the analytics can be performed. And in cases where the data comes from not only the ERP but some other sources, that relation linking that needs to occur in order for the analytic to run is all part of the secret sauce, if you will, to make that happen and get those exceptions reported. So basically, it's kind of like a server warehouse container that is part of the implementation of the solution.
Okay, Carolyn, thank you. And I think we're ready for the results of that last polling question. Again, the question was, do you currently use continuous monitoring software for data analytics? And the majority, about almost 2/3 of the respondents said no, they don't. So that's, maybe you've learned something today, and maybe you'll decide whether you want to use continuous monitoring software. We have a number of other questions, and I do want to say that if we don't get to your question, the staff here will forward that question to the appropriate panelist, and we will get back to you with an answer at some point. The next question relates to cloud. Are there any risks to using the cloud to support data analytics? And Patrick, I guess I would ask you this first. In other words, what risks does the cloud present when you're supporting data analytics, if any?
Oh, sure. No, well, the first place I would go is, there is data information security risk everywhere. So whether it's inside your shop or running in our data center in the cloud, we all need to be thinking about information security risk. So in our particular case, we're an SSAE 16 SOC 2 Type 2 certified data center and application layer, which just means it's a very rigorous approach to information security. And we're going to work perhaps hard or harder than you might to protect that information. Second, the other thing that we do to try to be careful about this is, there's some riskier information that we don't collect. So credit card numbers would be a great example. We get a tokenized, it's called credit card number. So if you think how they normally communicate with you, an email or something, your credit card company with the last few digits and not the whole number, that's the same thing that we get. And so it reduced, even if someone got that number, it's effectively not useful. And same thing, we don't bring in Social Security numbers. So things that cause really personally identifiable information, PII risk, or the things you want to be careful about. Frankly, you want to be careful about those whether you're using our cloud service or carrying it on your laptop, right? If you had old credit card numbers on your laptop and something happened to that, it would be a big stink, to put it politely, for you and your company. So as a cloud vendor, we're both careful in terms of what we have, and then B, we necessarily hold ourselves to a very high information security standard. So we think those risks are quite manageable.
Okay, Patrick, thank you. Question here for Bill Pollard. Something in the news recently a lot is the Foreign Corrupt Practices Act, and I know this came out back in the 70s, but apparently it still makes headlines today. Can you explain briefly some of the major provisions of that and how it affects fraud within the companies that might be experienced?
Sure. So the person who asked the question is right. The Foreign Corrupt Practices Act did come out in the late 1970s, but it just doesn't seem to be going away from the U.S. government's perspective. There are two main provisions to the Foreign Corrupt Practices Act. So it's a U.S. law which basically prohibits individuals for providing anything of value to non-U.S. government officials, which would be viewed as influencing a particular behavior. There are two main provisions. One is the anti-bribery provision, which is the prohibition around offering a bribe to an individual, and the second provision is the books and records provision, which says that you must maintain your company accounting books and records in a manner which reflects the true nature of your transactions. For most companies who are operating at some level globally and who have the potential to interact with non-U.S. government officials, and that is there's a very broad definition of what is a non-U.S. government official. The focus covers everything from selling and sales-related activities to licenses, permits, import-export related activity. So it's a very, very broad statute that that is difficult to detect, difficult to prosecute, and so you'll see very few prosecutions in this area. Most companies will accept some type of a government enforcement action, and most of the efforts are around that companies end up in trouble with is in the books and records area. And so actually a lot of what we talked about today about detecting fraud within your company books and records is very relevant for the FCPA.
Okay, Bill, thank you very much. And so before we go, and it's getting close to the top of the hour now, I would like to thank our panelists once more for their insights on data analytics to detect and deter fraud. And I hope that we have provided you with a lot of good practical information. Finally, I'd like to remind you about FEI's upcoming Current Financial Reporting Issues Conference at the Marriott Marquis in New York City on November 16 and 17. This year's conference will help you not only understand the regulators' hot-button issues, but our faculty of experts and peers will offer practical advice and real-world examples that you will not find anywhere else. And so to register, just visit www.financialexecutives.org/CFRI. And new this year, the conference will also be available via webcast. So finally, if you have any additional questions, and we actually got a lot of great questions, and I said before, we will forward these questions to the appropriate panelist, and we'll get back to you with good, solid responses. But if you have any additional questions, please feel free to contact us at www.antifraudcollaboration.com. .org.
Sorry.
Yeah. And we want to thank you for your time today, and we hope that we have provided you with some real value. Thank you.
Hello?
Hello. Are we still on?